Hello everyone, we are from Team 3. We will review a book from Peter Lynch called One Up on Wall Street. So from this book, Peter Lynch shared about his experience in market stock. So who is Peter Lynch? He was born in January 1944 in Newton and started his college in Boston College, where he studied for history, psychology, and philosophy and graduated in 1965. Then he earned his MBA grade degree from Barton School of the University of Pennsylvania in 1988. And Lynch started his professional career as an intern in Fidelity Investment. And after 2 years, he was hired permanently, focusing on textile, metals, mining, and chemicals in 1966. In 1974 until 1977, he became Fidelity Director of Research. And after that, Lynch moved to Magellan Fund. In Lynch time, Magellan Fund get the best 20-year return of any mutual fund ever. In Lynch period, achieved dollar success in range of stock such as Ford, Philip Morris, MCI, Volvo, General Electric, and several famous names. Please enjoy the review from our team. Thank you.
Okay, let's start with the first chapter, the making of a stock picker. There's no such thing as a hereditary knack for picking stock. This is the opening sentence in the first chapter of the book. In this chapter, Peter Lynch basically shares his story on how he became a stock picker. The chapter also gives an overview on how Americans view the stock market since the crash on 1929 onwards. And Lynch also shares his early history of learning stocks with milestones of stock market itself throughout the years. This provides an interesting insight on how life journey has helped him to understand more about the stock market. One good point from Lynch is that studying history and philosophy was much more better preparation for the stock market than, say, studying statistics. In chapter 2, Lynch talked about the Wall Street oxymorons. Lynch considered professional investing as oxymorons, where 70% of the shares in major companies are controlled by institutions, and those are the people who want to secure investments restricted by numerous cultural, legal, and social barriers. In this chapter, Lynch shares stories about great investors such as John Templeton, Max Hine, Michael Price, John Neff, and etc., which are part of the minority non-oxymoronic. These people have shown great performance in stock trades by having manifold stock they are trading with patience and good instinct. Chapter 3, is this gambling or what? This chapter reveals various instruments of investment, from bonds, money market, CD, or debt. He pointed out that in spite of crashes, depressions, war, recessions, 10 different presidential administrations, and numerous changes in skirt lengths, stocks in general have paid off 15 times as well as corporate bonds, and well over 30 times better than treasury bills. The logical explanation for this is that in stocks, you've got the company's growth on your side. You're a partner in prosperous and expanding businesses. In bonds, you're nothing more than the nearest source of spare change. When you lend money to somebody, the best you can hope for is to get it back plus interest. Chapter 4, Passing the Mirror Test. In this chapter, Lynch asks you 3 basic questions. The personal issues that should be addressed before you buy a share on anything. First, do I own a house? Second, do I need the money? And 3, do I have the personal qualities that will bring me such success in stocks? Your response to these questions are more important than anything you'll read in the Wall Street Journal. Chapter 5. Is this a good market? Please don't ask. Lynch mentioned that you don't have to be able to predict the stock market to make money in stocks, or else he wouldn't have made any money. Since the stock market is in some way related to the general economy, one way that people try to outguess the market is to predict inflation and recessions, booms and busts, and the direction of interest rates. Another theory that we have recessions every 5 years, but this hasn't happened the way so far. A question is asked, if professional economists can predict economies and professional forecasters can predict markets, then what chances does the amateur investors have? This comes down to his cocktail theory. He doesn't believe in predicting markets. He believes in buying great companies, especially companies that are undervalued and or underappreciated. If you had bought stock in great companies back in 1925 and held on to them through the crash and into the depression, by 1936 you would have been very pleased at the result. Lastly, in this chapter, Lynch said that the only buy signal he needs is to find a company he likes. In that case, it's never too soon nor too late to buy shares.
The second part of this book is about picking winners. It is the core of various investment strategies that Lynch has done in managing Magellan's. It was in this part he told me about recognizing a company whose share grew 10 times in terms of Lynch in Beggar. To achieve multiple profits is not easy, of course. There are criteria, there is a process, there is an introduction, there is an evaluation that is told in this section. He also reviewed some of the stocks he avoided. From here, we could learn a lot to avoid them. He also invited the readers to focus more on the story about how the company is good. Is it really good? How good are they? Does the story make sense? Etc. And then the interesting thing about this section, namely in chapter 7, is the categorization of companies made by Lynch: slow growers, stalwarts, fast growers, cyclical, turnaround, and asset play. By getting to know of the 6 categories of companies, we can continue the story of whether we will invest in the company's share or avoid it. Also, how much our portfolio in each of the company's categorization, except the slow growers that Peter Lynch avoided. From Lynch inspiration, this is why I began to focus more on the planned stock portfolio this year, because in reality, this is important. For stalwarts, the expectation of a 5 to 10-fold increase may not already exist, so the focus in this category is only 30% until 40% of our funds. For other categorization, we can use the rest to maximize profits.
There's something numbers that we need to know, and we need to notice is like, first one is percentage of sales, PE ratio, with which we can measure is that the PE ratio of any company that fairly priced will equal its growth rate. The cash position. Fourth, the debt factor, which is how much does the company own, how much does it own, and well known as debt to equity ratio. Fifth is dividends. Sixth, does it pay dividends or not? 7 is book value, more hidden asset. 9 is cash flow. 10 inventories, pension plans, growth rate, and lastly is the bottom line, or we call it the profit after taxes. We must do rechecking the company story, so it's very worth it. Whether we see the latest value line or the quarterly report, and inquire about the earnings and whether the earnings are holding up as expected. There's some phases of the growth company life. First is startup phase, which this company during this phase is which it works out the kinks in the basic business, but the risk is for the investor because the success of the enterprise is not yet established. Second is the rapid expansion phase, which the company during this phase is it moves into the new market and is the safest for the investors. The major phase is when the company begins to prepare for the fact that there's no easy way to company to expand, that this is the most problematic phase for the investors. As we periodically recheck the stock, we will determine whether the company seems to be moving from one phase to another. The final checklist: when we buy a stock, the more we know, the better one. This is the summary of the things we like to learn about stock in 6 categories. First one is stock in general. The PE ratio, is it high or low for this particular company? Is there any insider are buying, and whether the company itself buying back its own shares? The record of earning growth to date and whether the earnings are sporadic or consistent. Whether the company has strong balance sheet or a weak balance sheet. Second, slow growers category. We buy this category of stocks for the dividends. We want to check to see if dividends always been paid or routinely raised. If possible, find out what percentage of the earnings are being paid out as dividends. Third, stalwarts. There are big companies that are not likely to go out of business. The key issue is price, and the P ratio will tell you whether you are paying too much. Check for possible diversification that may reduce earnings in the future. Check also the company's long-term growth rate and whether it has kept up the same momentum in recent years. Cyclical. Fourthly, keep a close watch on inventories and supply-demand relationship. Watch for new entrants into the market, which is usually a dangerous development. And last, anticipate a shrinking PE multiple over time a business recovers, and investors look ahead to the end of the cycle. Fast growers investigate whether the product that's supposed to enrich the company is a major part of the company's business. The company still has room to grow, whether the stock is selling at P ratio or at near of the growth rate, and also whether the expansion is speeding up or slowing down. Turnarounds. Most important, can the company survive a rate by its creditor? How much cash does the company have? How much debt? How is the company supposed to be turning around? Has it rid itself of unprofitable division? Is business coming back? Are costs being cut? Also, will the effect be? The last category is asset plays. What's the value of the asset? Are there any hidden assets? How much debt is there to detract from this asset? Is the company taking on the debt or making the asset less valuable? And is this a rider in the wings to help shareholders reap the benefit of the asset? So, the more we know, the better we will get we choose the stock. So, choose the best category stock you may have. Thank you.
Okay, so now we came to the last part of the One Up on Wall Street by Peter Lynch. So I think in this last part, in the long-term view, Peter Lynch said about many things that it can help to your consideration to plan the investment stock in the long-term view. So I think before you notice that in designing your portfolio you must consider that 9 to 10% a year is the generic long-term return of the stock. It is the historic market average. And Peter Lynch also mentioned there is two long-standing debate. It is the one that say that put all your egg in one basket, and the one that say that don't put all your egg in one basket. It may have a hole in it. I think it is very wise because spreading your money among several categories of stock is another way to minimize the downside risk. And I think if you can convince yourself when I'm down 25%, I'm a buyer, and banish forever the fatal thought that when I'm down 25%, I'm seller. That's when you'll never make a decent profit in stock. I think Peter Lynch also mentioned the best time to buy and sell. There is two particular time that you can consider to buy and sell. The first is during the peculiar annual ritual. It is about between October and December. It is because it is holiday period. And the second one is during the collapse, drops, or burp of hiccups. There is no straight line of the company stock. It is always going up and down. I think that is time to consider. And also Peter Lynch says about the category of the when to sell your stock. It is when to sell when it grows, when to sell a slow grower, when to sell a stalwart, when to sell a silica, a fast grower, a turnaround, and asset play. And also Peter Lynch also mentioned many things like the 12 silliest and most dangerous thing people say about the stock price. The number one is if it's going down this much already, it can go much lower. No, you can predict that. And if it's going this high already, how can it possibly higher? No, you can probably predict that. And when it's rebound to $10, I'll sell. And next thing is it's taking too long for anything to ever happen. It is a stock investment, not for the quick cash. I missed that one and I'll cut to the next one, and then the next price is when the stock gone up, so I must be right, or when the stock is going down, so I must be wrong. There is no right and down. It's just buy to your intuition, and you must use your historical data to foresee the future. And then there is an option, feature, and short. Like there is no point describing how future and option really work, but because it is required and long-term exposition, after use you will confused, and knowing more than what might get you interested in buying more. And then the last is I don't understand feature and option myself. Then there is action for sorting stock. Sorting stock is like borrowing something from your neighbor and then selling the item and pocketing the money. Sooner or later, you go out and you buy the identical item and return it to the neighbor. Nobody is wiser, so it is not exactly stealing, but it's not exactly neighborly for people for doing that. And then it's like more like borrowing with a criminal intent. It is very tedious. And then in the last chapter, Peter Lynch says about the 50,000 Frenchmen can be wrong. Do you remember the several news events and their effect on the price of the stock? Like the man that we can predict is the political event. Like we have in the last month that presidential electrical election is the number 1 and 2. During that time alone, the price of IHSG stock price is rapidly going down. But after that event passed, the stock price of IHSG, the MICE is the price is rose slightly. And then Peter Lynch says about there are 50,000 stock picker who dominate the show, and then like the 50,000 Frenchmen, they can be possibly wrong, but for Peter Lynch says that only 20% of that 50,000, the last 20% of typical stock that move. So I think the idea that Peter Lynch want to say about is the idea is to make a quick gain and then quickly stamp out of the door. So I think there is some consideration, some summary of the book. I think the long-term view is that how do you plan for the long-term action of your stock investment. I think that is the last part 3 of One Up on Wall Street is all about. Thank you.
So, guys, after we read this book, so what do you think is the interesting part from this book?
Okay, for me, I think there are 3 things that interested for me. First, don't overestimate the skill and wisdom of professionals. The second is to invest in a house before you invest in a stock. And then the third is to ignore the short-term fluctuations.
Okay. For me, this book is very inspiring because Peter Lynch want us to develop companies. We must know how really good the company, how really bad, and then Peter Lynch define companies into 6 categories.
Okay, from me, from this book, we can know and need to understand more the nature of companies and we own and the specific reason why we put in stock. And then also by putting our stock in 6 categories, we have a better idea of what we expect from them. And then there's what big companies have small moves, but small companies have big moves.
As I think very best part of this book for me is that don't put all eggs in one basket. And then know when to sell and when to buy. And then the last part is when you have quick gain, you must step out quick. So I think that is.
Yes. So I think that's all review from this book from our team, and thank you.